Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Hubspot is one of the SaaS companies that's really made a comeback in the market. The stock is up nearly 100% so far in 2023. But is this still a buying opportunity, or is this one of these companies that has just gone too far too fast? That's what I want to dig into today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to start with a quick chart of some of the recent history from HubSpot. You can see here in purple, the price of HubSpot stock has nearly doubled so far this year. The market cap is in green. I'm going to come back to that. So almost a $26 billion market cap as I'm recording, and revenue of $1.8 billion, net loss of $142 million. So that's the first thing that jumps out to me right here, is that this is a very expensive stock, paying nearly $26 billion for a company that's generating less than $2 billion in revenue. Not typically the kind of premium that I want to pay, especially for a company that's losing money. But let's dig into some of the numbers here. This is the first quarter 2023 results. You can see the revenue was up 27% to $501.6 million. Operating income was negative, but on an adjusted basis, so non-GAAP operating income was actually positive 13.5%, up from 8.8% a year ago. Again, here's something I want to dig into a little bit later, because this is a big gap between these two numbers. 13.5% and negative 8.9% is more than a 20% difference in the operating margin that we're reporting from a GAAP basis to a non-GAAP basis. So what's going on there? I will come back to that. Same thing is going on with the net loss. On a GAAP basis, lost $38.3 million. On a non-GAAP basis, profit of $61.6 million. So that looks a lot better. And then the balance sheet, $1.6 billion in cash. That's great. Generated $81.1 million in cash from operations and $85.2 million in free cash flow in the first quarter. So from a cash standpoint, things are getting a little bit better, but a little bit concerning that those operating and net margins are negative on a GAAP basis. I want to cover HubSpot's growth and the slowing growth the company has. But before we do that, I want to cover this operating loss. Here's the most recent quarter, $44.8 million, stock-based compensation, $83 million, amortization of intangible assets, and then restructuring charge of $28.6 million. The restructuring charge may be a one-time thing. Sometimes companies that are constantly restructuring, you want to just kind of say, well, that's a cost that's going to be incurred all the time. But I think right now, where we are in the software space with some of the cost reductions that are going on, it's fair to say that this is probably a one-time charge. So I'll accept that. But this stock-based compensation is just an incredibly high number for a single quarter for a company that's not profitable. So that's really a red flag to me, is this stock-based compensation number is extremely high. Now, with that said, I want to go to what the rest of the year looks like. So remember, $501.6 million in revenue in the first quarter of 2023. So look at what management says they expect for the second quarter and for the full year. $503 to $505 million in revenue. So a little bit of growth expected quarter over quarter, but not much at all. You go out to the full year, and now they're expecting $2.08 to $2.088 billion in revenue. So just do some simple math there, and they're actually expecting revenue to be stagnant, potentially even decline in the second half of the year. So this is not a growth company on the revenue side. I think that's really important to highlight, because I mentioned early on that you're actually paying a pretty big premium for the stock with a $26 billion valuation and less than $2 billion in revenue. Now, by the end of the year, that might be over $2 billion in revenue, but still a price to sales multiple of over 12 is really expensive, especially if the company is not growing at all. Non-GAAP operating income is expected to be $275 to $279 million. But again, that stock-based compensation that I mentioned earlier is going to eat away at that. So that's going to dilute shareholders. And if the company isn't growing enough to share some of the growth with employees and a big chunk of the growth with investors, you're just going to be diluted away as an investor. So the fact that HubSpot is not growing, but is giving away a ton of money in stock-based compensation and is not reporting a GAAP net profit is really concerning to me. A lot of software companies are in a similar position today, where growth is slowing as companies try to cut back on expenses anywhere that they can. That's putting pressure on software costs. And that pressure then makes its way to a company like HubSpot's operations, where they're trying to cut costs as much as they can, get to profitability and positive free cash flow. The good news is that HubSpot is free cash flow positive. I highlighted that. I think that's going to be the first thing you're going to want to look at with any software company. But the bad news is this is not a company that's expecting to grow much at all in 2023. And beyond that, I don't know how much growth that we can expect. So we're paying a big premium, over 12 times sales, for a company that's not growing and is giving away a huge amount of value in stock-based compensation. This stock may be up significantly in 2023, but right now in June, I don't think that it's a buy. And I simply don't see the upside from the price that we're paying right now. If the stock was significantly cheaper, the story would be different, because I think this is a valuable company, but I want to get in at a better price. And I want management to give away less of the company in stock-based compensation, actually incur those costs by paying people in cash. And let's see what the actual operating costs of the company are, as opposed to paying something like stock. But that's what I think. What do you think? Leave those comments in the comment section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.